welcome to the show. I'm your host, Caitlin Cormier. Income investors often wrestle with a tough choice when considering investments that might be right for them. On the one hand, they could opt for stocks that aim to deliver higher income yields. The problem is that sometimes comes at the expense of long term potential upside. After all, those dividends tend to come from the profits that could have been reinvested into the company. On the other hand, investors could choose stocks that offer greater potential for capital appreciation. But you guessed it, they often don't pay much in the way of dividends. Well, what if I told you that there's a new type of investment that aims to strike a balance between the two, as in higher income yields and exposure to the long term upside? They're called yield shares, an exchange traded fund pioneered by Purpose Investments in late 2022. They hold shares of just a single underlying stock and use complex investing strategies to boost the income yields on more growth oriented stocks. Now, there's a lot to unpack with these funds, so let's find out more from our guest speaker. Joining us is Som Seif, founder and CEO of Purpose Investments. Purpose is the first investment firm in the world to offer single stock ETFs focused on higher yields. Som, thanks for swinging by to chat with us.
Great to be here, Caitlin, and thanks for taking the time.
Purpose Investments is the first fund provider to launch yield focused single stock funds in Canada. What inspired your team to create these products?
Yeah, it's a really good question. At Purpose, we're always trying to find, where are there challenges that investors face when trying to build really strong investment portfolios, but also to be able to execute them with an institutional quality. And one of the things that we believe in is always that when you're investing in stocks or individual companies, that option writing actually can be a really powerful component of the return stream in those stocks. And so the challenge, though, for many investors and advisors is that, doing option writing on stocks and doing all the balancing and all the work that goes into that can both be difficult and expensive from a friction perspective when done by retail. So, we effectively package them up into the yield share strategies and, allowing investors to get exposure to the stocks they love, but with an opportunity to generate some really strong, attractive income and some exposure that might participate in some longer term return upside.
Okay, trying to capture the best of both worlds all together in one product. Well, let's get into the conversation. So, first off, it's important to clarify that there are different types of single stock funds out there. So, how would you describe the ones Purpose has developed compared to others on the market?
There are different products out there, and some of them are focused on leverage in a very heavy way. So they might use 2 times leverage on a single stock, both on the upside and in some cases even on the downside. So meaning that it's like shorting a stock on the downside, but you're substantially levered to that return. What we find in those scenarios is that they're not really best for long-term investing. They're very good for short-term trading and taking a directional position in a very short perspective. The other construct is when they use synthetic exposure, so they don't actually own the stock underlying it, and they might use complex and complicated derivatives, which for retail investors can be a little bit difficult to understand, and also to recognize how they might play out in the long-term return. So, we've really focused on how do you just make something really simple, and more importantly, very transparent in how they can be utilized, and more importantly, how they fit into an investor's portfolio. And, I think our view has always been that for a long-term investor, what you're trying to optimize for is how do I get exposure to the stock I love? How do I, participate in the volatility of that stock, not just by ignoring it, but potentially generating some return from it, and generate some income using covered calls. At the same time, also lightly get some exposure to leverage, as opposed to heavily using leverage, so that can be a really strategic position for your long-term holding of that stock. So, I think those are the key things that we've done to differentiate ourselves.
Okay, and you talked about some key things there. So, how do yield share ETFs aim to deliver both that exposure to the long term performance as well as high yield income from it? How do you accomplish that?
In each of the yield shares, we have added a relatively modest amount of leverage. So what that means is, if we put $100 into the portfolio, we're using about 25% leverage, which would mean that you get about 125% exposure to that single stock. That you have on the upside 125% of the upside exposure. And at the same time, though, you have symmetry on the downside. And so there is a little bit more risk related to when you use leverage. But as an institutional money manager, what we've found is that when you buy companies that are long-term, good businesses fundamentally, in the long run, that having a little bit of leverage with a low cost of leverage actually can boost returns in a really positive way. It also allows for institutional execution on that. So, as a large money manager, we're able to get very low cost of funding of that debt or that cost of capital. And so, relative to a retail investor's direct margin account, we can actually get a very low cost of capital for the leverage, which is a really nice pass on to the investor when they buy this versus doing it themselves with margin. The second component is that we are then writing options on that stock position up to about 50% of the holding. So what that means is that you have an exposure to a single stock, a little bit of leverage, and you have an option overlay that is looking to generate income off that stock up to a certain amount, but still also allowing for the stock to have good long-term exposure to its upside on top of that. I talked about, option overlay of about 50%. So what that means is that if we have, again, 125% exposure to the stock, about half of that will be written with single stock options on the stock that we're holding. And those are, we'll get into some of the details, but those are covered call options. So it means that we own the stock and we're writing options on the stock. And what that does is it really lets you generate a yield on the stock up to a certain amount. It's not 100%, so it still allows for the stock participation on the upside, but it also isn't so low that you're not, generating enough income for the activity that you're ultimately undergoing. When we write options, one of the things that we do is really important is we write options in a very institutional way. So we write them first between a 0% and 5% out of the money. So what they call is at the money or 5% out of the money, somewhere in that range. What that allows for is that you're writing a maximum amount of the stock, and you're getting a really good income, but you're still giving a little bit of room for some upside. And then the second thing is we're also doing a lot of work around the institutional staggering of options, which we'll get into a little bit of detail as well, so that you're using multiple strike prices, multiple terms, so that ultimately, volatility in the market doesn't ultimately grab your stock and pull you out of the stock at any point on any one day. Last thing is that when you're using options, you're able to generate enhanced income, but also that income comes in a very tax efficient way for Canadians. Option income, when done from a long-term investing perspective, actually is treated as capital gains. And so all of the distributions that we pay out on this will be treated with a tax efficient income of capital gains, and we pay out monthly. So what that really does is it gives not only a nice enhanced return, but also a nice enhanced income from a tax perspective as well.
Okay, and you had mentioned before, like about other funds that do leverage and they do like 2 and 3 times. So 25% compared to those is more of, like you said, like a long term versus something with that 2 and 3 times, which would be obviously a completely different sort of a return.
That's right. And when you start using leverage levels that are greater than 25, 30%, you start getting into more speculative exposures. So short-term movements of the stock can actually whipsaw you quite meaningfully and can result in having to rebalance the portfolio and the leverage. So for example, when you start getting in specifically into like the 1.5 to 2 times, you can actually have to rebalance the portfolio on a daily basis. And that means that daily volatility can really disrupt the path of return. So, when you get into sort of return leverage that is more like 25%, it allows you to really participate in the long term from a long-term investor mindset, and just get that slightly added enhanced return stream from the leverage. What's really important though is that, some people might ask is, well, there's a cost of that leverage, and there is. And what that really, when you complement that with the next component, which is cover call writing, remember, we're generating a really attractive income. And what we always balance is how much income are we generating versus the cost of the leverage. And what we aim to do is always have our income on the portfolio substantially greater than the cost of the leverage, specifically on the added 25%. And so not only are we going to get low cost of debt because we're an institutional money manager, we're also going to aim to generate a covered call income that is greater than the cost of that debt, specifically on the leveraged part.
Okay, and covered calls, let's jump into that. So can you explain like what it means to sell a covered call and how it's used in this product?
What we do is what we call covered call writing strategies. And so writing is a construct of selling. It's like you're selling an option. But what we use is covered calls. And so it covered means that you're writing it on a stock that you actually own. If you were to be non-covered or uncovered, it would mean that you would be writing speculatively. But when you own the stock, it's not as speculative, because what you're doing is you're owning the stock and you're selling an option that effectively allows for the buyer to buy that stock from you at that price. The concept really is that you're using this as a way to augment or enhance the income that you're generating from the stock. And so by selling those contracts, you are giving up the upside at the price that you write the option at, but they pay you an income for that. And that premium, as they call it, is that enhanced return. What happens is that that stock may go up in the short term, may go sideways in the short term, but oftentimes there's a lot of volatility in that stock. It might go up and down, ultimately getting to where you think it's going to be. But in the interim, there's a lot of volatility. And most investors ignore that volatility. Actually, it's considered negative to them because daily price movements to them can be somewhat heartening and difficult for people to see. But we look at it and say, why not take advantage of that volatility? When we write options, as I said earlier, we write them anywhere between at the money. So if a stock's at $100, we write, let's say, somewhere about $100, or up to 5% out of the money. So between $100 to $105. And so somewhere in that range. So if the stock goes up from $100 to $102 and we've written it at the money, well, they will effectively buy the stock at $100. We will give up that $2 upside, but we'll have generated income that will be attractive, and we'll get that on a regular basis. But other times when the stock doesn't go up, we've generated that income and we still own the stock. So the beautiful thing is no matter what happens, we always generate that income. And in some cases, the stock gets called from us. In some cases, the stock doesn't get called from us. But in all cases, we generate that income.
Okay. And would you say that the ideal situation would be that you're writing these cover calls and they're just expiring, they're not being exercised? Would that be kind of like the ideal situation with this?
Yeah, I mean, the perfect scenario oftentimes is that you write the stock option, let's say 1 or 2% out of the money, and the stock goes up only by 1% and never gets called. And so you get a little bit of the upside and you get the income. That's a sort of a Goldilocks scenario, right? It never really happens. And so the reality is that stocks go up and down. And so that's why it's really important not to have, call it a binary situation where all your options expire on the same day or are written at the same price. We stagger the maturities and the position. So we use what we call laddered maturities. We generally write, 0 to 30-day options. So, options, within a month, and we stagger them. So we might have 8 to 12 different option positions on every single stock every single month. And what that allows for is the laddering of maturity. So as stocks go up one day and down the next day, some days they'll be in the money and some days they won't be, but not everything will be in the money at once. So if the stock was to have a specific high day, some options might get called, but others may not. And that's the benefit of using a vehicle like yield shares versus trying to do it yourself, both as a retail investor or even a sophisticated retail or institutional investor, where it's a lot of time and consumption, but also costs and friction to be able to replicate the type of strategy we do.
Okay, very interesting. I think that'll help our audience kind of to understand that piece of it. And for those in our audience that are interested in learning more about covered call ETFs and how they work, watch our webinar, How to Generate Passive Option Income on a Budget. You can find it in the Learning Center in Webroker as well as on TD's YouTube page. Okay, so we've gone through how those strategies work. Now, put it all together for us. So, why might an investor choose to hold a yield shares ETF rather than simply holding the shares directly?
The benefit, of course, is that you're combining modest leverage with a covered call overlay that writes or aims to write, enough options to generate a very attractive income yield, much greater than the underlying stock would pay if it does pay a dividend at all, and to generate that and pay a monthly income to the investor. When you are buying options, one option contract usually represents about 100 shares of the underlying stock. That's just to do one option contract. And so this can be very expensive for a retail investor. So for example, if you had a company that had $100 stock price and you wanted to, you'd have to hold 100 shares, and that's about $10,000 of that stock just to sell one option. Now think about doing that with 8 to 12 options, staggering the maturities, doing it across multiple maturities, all that stuff. And so that's why when you're able to benefit of something like yield shares, which is doing this with all of that sophistication at scale, it's a very compelling package.
Okay, very good. Let's talk about performance a little bit. So in different market environments, how might yield share ETFs tend to perform best and worst if history is any guide?
So what happens is during kind of markets that are kind of going sideways, slightly positive, slightly down, though, they call it the returns that are plus minus 5% to sort of flat. This is a really optimal time for strategies like yield shares. It's awesome because you're able to generate current income. You're not giving up a lot of the return on the upside. You're generating that income that from the option writing. The leverage doesn't really negatively impact you because, again, you're generating more income than the cost of leverage. And, you're able to generate, in the case of the stock goes slightly down, some enhanced returns through that income. They also can outperform during bull markets, but when there's low volatility. And generally, when there is a bull market, when the stocks are going up, volatility is generally low. Volatility is usually higher when stocks are falling. It's just something that you will see historically. But during a bull market where volatility is low, it actually can be, the yield shares should actually perform quite nicely because you've got the enhanced yield from the option income and you've got the exposure addition through the leverage. And so the combination of two should provide a really nice long-term return, similar to owning the stock, but you're getting current income as well. And then lastly is you should outperform during bear markets with high volatility. And why is that? Because the market price of the stock is going down, but volatility is high. So you're able to generate very attractive, rich premiums by selling the options. And this will augment against the downside risk of the stock going down. And so it's really important that those are environments where this can really outperform. Where the underperformance can come in would be one, if you have a very attractive bull market, but with high volatility. And so what this would be is that, the stock price is going up, but there's also a lot of variation in that stock price. And so the challenge there is you are getting the benefit of the stock price going up and the leverage to that, but you're also getting whipsawed a little bit on the option overlay. And so you're getting called on the stocks very often, and you're getting pulled out of the stock. And so you just can't write out the money enough or whatever it be. But generally, you're still going to be participating in the stock price. So you just might underperform versus owning the stock outright. The second time you might underperform is when there's a bear market, but we have low volatility. And why this is important is because you have leverage. So the stock price is going down because of the bear market. And so the underlying stock is falling, but with a leverage, you don't get enough volatility income or income from your option writing to offset the extra enhanced downside from the leverage. So those are your two environments that you would probably have, historically seen, underperformance versus owning the stock, just outright.
Just a quick reminder to our audience, we delve into more details about other types of leverage funds that use option rating strategies in our webinar, Funds That Help Supercharge My Passive Income Plan. So if you'd like to learn more and about how they might suit an income investor's goals, check it out in the Learning Center or on TD's YouTube page. So Som, we've talked about a lot of different factors with these funds, but what are the risks that investors might face with this type of investment?
Well, I think that the number one risk is the stock that is underlying the yield share is not a good company. So its stock price goes down, because we have a little bit of leverage. that stock price going down, would be a little bit enhanced. And so that is the number one risk. It always will be, whether you own the stock directly or you own it through yield shares. If it's not a good stock or it doesn't perform well, it's going to be the biggest risk. I think the second risk is always that the strategy that we execute is the wrong strategy for the wrong time. And so, for example, we option overlay, with 50%, but the stock just skyrockets, goes up substantially. Now, I will say that you're going to do well. You're still participating in the stock. And so the risk is that you just underperform doing really, really well. But the reality is that that's another risk that you face. And it's just a trade-off, right? And then the last risk is that purpose executes poorly. And what I mean by that is that as a money manager, we are actively overlaying and doing all of our option strategies and doing all this stuff. And if we don't execute that as we articulate well, or we time things incorrectly, then it could be, I think a bad outcome.
Okay, single stock funds aim to provide a higher income yield, but of course, there's no guarantee. So, what could actually jeopardize those higher yields?
Yeah. So what's really important is when you're writing options, what matters in the amount of premium you collect is the volatility. So, if you have a high volatile stock, you might generate a lot of premium, but you also might get whipsawed a lot. If you have a low volatility stock, you might generate very little premium, but it's a question of, are you generating enough? So generally what matters is the volatility of the environment, call it in the sweet spot. I go back to the Goldilocks example. If it's in the sweet spot where you're generating enough volatility to generate a nice income, but not too much volatility that you're getting whipsawed, that's a perfect environment. But if you get into a very low volatile environment, so we've seen these in the past where, a couple of years ago, the markets were very, very low volatility. If the stock is really trending upwards, you may not be generating enough income to offset that, call it upside loss that you're getting through the option being called away from you or the stock being called away from you. So it's really important to understand that as an investor. And, trade-offs are important in these types of strategies that have more structure to them.
And with those yields, are they pretty consistent over time, or do you see variation in those yields with these types of funds?
Generally, we try to manage them to be as consistent as possible, but they can be, they can differ. So, there will be some, years where income is a little higher and some years where the income is slightly lower. But we try to kind of balance that as best as we can in the yield shares.
Yield share ETFs may hold shares of US companies, and that exposes investors to this currency risk if the value of the US dollar changes. So, how do yield shared ETFs account for this?
Yeah, so right now, all of the yield shares that we've launched are based on US stocks. Of course, from a Canadian investor, when you buy US stocks, there's a currency exchange and a currency exposure. In yield shares today, we hedge out that exposure. So one of the another benefits to Canadian investors is one, you're getting exposure to the US stock, but you're buying it in Canadian dollars. So you don't have to convert your dollars into US dollars and pay the transactional foreign exchange costs. But two is by hedging the exposure back to the Canadian dollar, what we're also doing is taking out the risk of volatility of the US dollar in the purchase of that stock. So when the stock, you're really buying the company for the fundamentals of the company, not for the direction of the US dollar versus Canadian dollar.
Income distribution from funds are typically taxed as a form of dividend income. How do yield share ETFs help manage the tax implication of their distributions?
That's right. And so dividend income is generally coming from a stock, but with yield shares, as I said earlier, because most of our income will be generated through what we call, covered call writing, covered call activity in a stock that's being held for the long term is actually treated as capital gains. And so it's a much more tax efficient income. So all the distributions or majority of the distributions that we pay on yield shares will actually be a very tax efficient capital gains income. And that's taxed at about 50% of the marginal rate of tax. Dividends are generally at about 68%, 70%. Net. So you have a nice enhancement by using capital gains income versus dividend income.
The question that's probably on everyone's mind, management fees. So obviously a more actively managed type of fund. So how do these single stock funds generally compare to the industry average for management fees?
Yield shares have a management fee of 0.4%, so 40 basis points. Just to give you that in context, many of the U.S. single stock ETFs, the ones that have lots of leverage and sophisticated synthetic strategies, things like that, they have management fees that are approximately 1%. So we're substantially below that. And then also when you look at some of the other products that are in the marketplace for similar constructs, so like we have the Canadian Depository Receipts, the CDRs, which are traded in Canada to give exposure. They don't use option overlays. They're just really a way for Canadians to buy US stocks. Those have a FX. They don't have a management fee, but they have a FX, call it cost, that goes into hedging the currency of about 0.5% per annum.
And so, finally, what are some factors an investor may want to consider when researching and ultimately choosing between yield focused single stock funds?
Well, number one is always what's the stock that you're buying underlying it, and do you like the fundamentals of that company? And so, you know, there's no point in buying any yield shares or any stock unless you actually believe in the long run you're going to make money on that and you like the company. These are not built for speculation. They're not built for short-term trading. They're really built for long-term investing. So, do you like the company? Is it a good business? Is it the kind of stock that over the long run you think is going to perform well for you? Second, I think you want to look at the degree of leverage in the case of a strategy. The more leverage you use, the more leverage that a single stock exposure might have, the more volatile you're going to have exposure to the company's upside and downside. And so you want to be very careful with the amount of leverage. And that's a factor. What portion of the portfolio are you writing options? So as I said before, we are writing 50% of the portfolio. If you write less or more than that, you'll see either less income generated or more income generated, but also have trade-offs on the amount of option writing. So, some funds out there will write 100% of the portfolio and generate this very juicy, attractive yield for the investor, which will look great, but you're not participating really in the stock and its upside. The second concept around option writing that's important is how much of the what they call out of the moneyness or moneyness of the options are they using. So some stocks will write at the money. Some stocks will write far out of the money, so like 10%, 50% out of the money, which means that you're generating less income, but you're getting more of the participation in the stock if it does go up. But that's a trade-off again. And so it's really important. And some stocks even write in the money. So meaning like they generate more income, but they're writing below the current price. So there's a high likelihood that they'll get the stock called from them. It's the combination of those things together that really matters. And I think it's really important that all investors understand each of these, because each of them, the decisions result in different outcomes for the long-term investor.
And investors would be able to find this information on the company's website, like the issuer of the ETF.
That's right. So on Purpose's website or on any ETF company's website, they should have all of this information. It should be in the investment strategy, in both the prospectus and the fund disclosure documents, and on their websites. But also, they should be sharing this in the way that they market the fund very clearly.
Okay. All right, we're going to have to leave it there. Thank you so much for walking us through the ins and outs of these yield-focused single stock ETFs. They sound like a very interesting product for income investors to consider. Any final thoughts that you wanted to share with our viewers?
The only thing I'd just one more time say is that I think for investors, it's really important to understand what you're buying. Make sure you're understanding the outcome in different environments, as we've talked about. And most importantly, understand that every form of investment product has trade-offs to them. What we've tried to do is bring a high quality, sound investment strategy with low costs, and really packaged in a really unique way to give investors choice. A great way to get exposure to the stocks they love, but with a little bit of enhanced income and some potential upside.
Okay, thanks again for joining us, and all those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See y'all next time.